and households. So negative impact on the real economy has been a really the truth, the concrete kind of implication of the European banking sector being so weak. But that was not seen in February 2012. What happened since February 2012? As one case company, Bankia, Spanish company, this is their announcement in April the 1st, 2012, saying that they had increased their solvency to 10.6%. They themselves, a listed company in a stock exchange releases, they highlighted that this capital strengthening situates Bankia as one of the most highly capitalized institutions in Spanish financial sector. So they have been able to increase their core tier 1 capital ratio. No other large European credit institution has achieved such substantial improvement. Okay, pretty bold statement. Sounds that Bankia was doing extremely well, isn't that right? That was April the 1st, 2012. So everything was supposed to be okay. Bankia, as one of the potential crisis company banks, was doing well. The equity ratio, the balance sheet was strengthening. But then comes but. Remember, this was April the 1st. May 27th. So in less than 2 months' time, Bankia came public and said that you need to give us 19 billion because otherwise we go bankrupt. So how can it happen? So as this one case company, which was only one bank, kind of missing 19 billions, plus some other, especially Spanish banks, as we will see. So this example showed that unlike what European Banking Authority in February had thought, unlike what Bankia had publicly told in April, so already in May, we recognized that. This is from Financial Times, July 2012. So we learned that there had been kind of misleading information being published by Bankia. There has been a kind of fraud. Bankia has kind of misstated its annual result and the balance sheet. And altogether, the Spanish banks said that we need altogether 100 billion European rescue money to keep us not going into bankrupt. And just think of this, 100 billion European Spanish banks, and they were able to threaten the whole European the leading politicians by saying that if you don't do this, it's kind of self-evident that we will go belly up, and we will in this interconnected world that will lead to collapse of many other European banks as well. So that was an eye-opener to a regulator, to the central bank, for the leading politicians, that how is it possible that this really happened? And that was one question. And the second question is that how do we make sure that we will never ever face this kind of situation anymore? That banks can threaten us with these kind of pretty hostile requests to provide, say, 100 billion, which we can't say no, because if we say no, the whole banking sector will collapse, and that will obviously collapse the real economy as well. So you could say that the first stress test, which was published, the results were published in February, that was you say that they looked pretty ridiculous. So there was no trust in the stress testing system after these news. 2014, the next round of stress tests, plus something called asset quality review. Now we come to something called European Banking Union. European Banking Union consists of 3 pillars, which I will explain in a few minutes. I will explain this later. But one of these pillars is the single supervisory mechanism. So that was the one of the key kind of ingredients in this European Banking Union, was the recognition that if you think kind of that Bankia listed Spanish bank, so they had falsified their annual statements. They had been accepted by the management, actually prepared by the management, and then accepted by the board of the bank, and then accepted by the financial supervision of Spanish banks. So how can it be that the financial supervision in Spain did not find out that there was 19 billion missing from the statements? So that was the question. And the learning from this was that on the European scale, we cannot let the regulation to be on a national level only. But we need something called a single supervisory mechanism on the whole European level. Because what happens in Spain doesn't stay in Spain, or what happens in whatever Greece doesn't stay in Greece, what happens in Finland doesn't stay in Finland. So as the market is kind of more or less banks are operating, even though the home base could be in Spain, they do transactions with other, especially European banks. So that was the lesson number 1 from this the Spanish crisis, that we need European level supervisory. And part of this, and that was a big change to what happened in previous, before the crisis, prior to the crisis, was that something called asset quality review was executed as part of the second round of stress tests in 2014. And the aim was to get a clearer picture of European big banks before European Central Bank becomes their supervisor. So this was a big change. European Central Bank said, okay, we will become the supervisor directly of the biggest banks in Europe. And their smaller local banks, their supervision will be they will be supervised on a national level also in the future. So for European Central Bank, as I added here, to increase European Central Bank's credibility as a supervisor, before European Central Bank was willing to take the responsibility to supervise these big banks, they say that we will know, because it's our credibility kind of at risk. So we want to go through very thoroughly kind of what these bank balance sheets really are about. So that was this asset quality review. And what was done was focus on equity capital. It was not only liquidity kind of exercise, equity capital, and especially the non-performing loan classification, NPL, non-performing loans. So that was the biggest concern. And collateral values were also checked. Okay. As you can see there, for the sake of clarification, there's no need to remember these parameters. They are just for illustration only, but just as an example, what were these adverse scenarios that were used in this exercise? The baseline scenario was that the GDP would grow by 1.5% and so on. There was an adverse scenario that it would decline by 0.47 and so on, and there would be a significant fall in employment to up to 2016, increasing government bond yields, and some other kind of housing price declines and so on. So considering these adverse development in real economy, the test was that do banks still kind of satisfy the criteria that the baseline scenario was that their equity tier 1 ratio would be 8%, and in adverse scenario it would not fall below 5.5. So those were the parameters. What were the results? The results of this asset quality review / stress tests was that there were troubled loans which were 136 billion higher than what banks had reported. So banks had told kind of before this exercise that we are doing fine, but Italian banks, for example, they needed to reclassify the billion worth of loans, Greek and German banks 8 and 7. So they needed to be classified into non-performing. So the risk that the customer will not pay them was pretty high. So that means that banks needed to increase their loan provisions by 48 billion. So that was a massive kind of thing. And then question is, why do banks claim that their loan book is kind of healthy? Why don't they just admit that, kind of our loan book, the receivables are pretty risky and there's a higher kind of probability that the customers will not pay them? It simply has to do with incentives, and especially for smaller banks, they cannot kind of revise their asset portfolio, their receivables portfolio, as it might lead to kind of the bank's equity ratio to go below the threshold level. So this is something called kind of a zombie bank. This is an article from Bloomberg in 2017 was that this is a phenomenon that we learned and happened in Japan almost 20 years. For almost 20 years, there was a real estate bust. Real estate prices kind of collapsed, but banks were not let to go bankrupt. So kind of that led to just banks being kind of trying to survive day after day and trying to kind of avoid any write-offs of these receivables. But obviously, zombie bank cannot grow. Its price, equity price is so low that they can't raise new equity. They're just kind of like zombies. There are no good choices when zombie banks are on the march. Now, after 2007, the risk was pretty evident in Europe that we would see these zombie-like banks also in the European markets. Some positives of this 2014 stress tests. It was recognized that many banks had been increasing their equity, so strengthening their financial stability, and there was obviously kind of increased transparency after this asset quality review. The impression was that now the regulator really knows better what these banks' balance sheets really are about. Some criticism was also raised. There were quite a few banks that kind of that really failed, and the question was that are these adverse scenarios too soft? How about if kind of unemployment jumps more, or interest rates jump more, or whatever, GDP goes down more? And there were some alternative measures by academics suggesting that actually the real shortfall had been kind of 450 billion. Okay, and then the question is that kind of this is just as we were discussing on when we started, as Bernanke said that what happens on Wall Street kind of influences on the Main Street. So it is not only kind of a banking sector related problem, but this really has consequences for the real economy. If banking sector is losing, So banks can no longer provide loans and other services for customers who might kind of who most probably have kind of need for capital. So the question is that will lending by banks increase? You could say that, okay, there was a risk that the tougher the regulator is, they force banks to shrink their operations, and that would have direct consequences in the real economy. So it's not kind of black and white what the regulators would say in this kind of environment. These were the parameters that were used. And then we came to 2016, and specific of this 2016 stress test was that there was no specific capital ratio, kind of like a lower limit. It was not communicated. The top performance were Nordic banks, but there some banks were kind of facing difficulties, especially the Italian, again, Monte dei Paschi, the oldest bank in the world, Monte dei Paschi, the first ever bank kind of being built. Monte dei Paschi has been struggling kind of since the first stress test ever. Considering the adverse scenario, Monte dei Paschi had been insolvent. But big banks, Deutsche Bank, Commerzbank, and Barclays, say German and British banks, they were also doing pretty badly in the tests. So 2011 to 12, we thought that, okay, the trend is upwards. The banks have been kind of saved. Now in 2016, kind of we learned that, okay, banks are still kind of suffering, especially Italian banks, Monte dei Paschi di Siena, UniCredit, the stock prices were kind of going down. There was a Brexit vote and stress test, and everything kind of just bad news still. So the trend was not upwards, but downwards. And if it's just think of the banking sector, the valuations are referred 4 times price to book in 2008, and now all the headaches that banks have faced since the banking crisis. So there's a fintech kind of pushing fintech we'll discuss when financial innovations will be our topic. Cyber attacks, maybe, yeah. Historically low interest rates, something that Mikko was referring to, that is something that we will discuss. The profitability of the banks typically is lower the lower the interest rates are. Shadow banking we'll discuss also later. There were some new players in the market kind of entering or trying to take their part in, especially in the profitable kind of banking sectors. Non-performing loans, a big headache, a mountain of non-performing loans. In overall kind of European economy, growth has been pretty kind of low. Regulation hitting, kind of tightening. You could say overbanking. Some people say that, okay, some analysts say that there are too many banks in Europe to start with. So many headaches in 2016 in the European banking sector. So not an easy environment to run a profitable banking business. And then came the last one, 2018 stress tests. European Banking Authority organized another European-wide stress test exercise, and they said that they expected to publish the results in November. And now, again, there was no pass or fail, and banks were doing relatively nice, but then we had kind of another headaches in the markets, again, such as kind of Italian bond slump and the Brexit were another headaches. But overall, you could say, and taking a bigger picture, since 2008, this picture kind of highlights or summarizes the development, how much has happened, and this has been for better in terms of the strength of the European banking sector overall. The European banks tier 1 ratio, which is was around 8. This is the average of the biggest European banks in 2008. Just a second. I'll take a look at kind of, sorry. In 2008, so from 8%, the average, say, let's call this for the sake of simplicity. I will explain how tier 1 capital ratio is being measured on next Tuesday. Let's call this as an equity ratio. 8% had improved to something like 15, 16%. So doubled in 10 years. So massive kind of a strengthening of the balance sheet. And this is something that banks shareholders kind of has been criticizing, that we need to have too much kind of say skin in the game. Too much money is being kind of tied to the operations, but this is regulator saying that, okay, we see your criticism, but this is the only way to go. We want you to have money invested in the operations, so that if something really happens again, something bad happens in the market again, and it's just think of kind of, we had as a COVID crisis, so banks have been doing relatively nice, well, through these years still. As just one case company, as Actias, if you look at kind of even in the spring 2020, Mikko was kind of showing that kind of the Actia was a profitable company. Okay, the profits were lower, but still they were making a profit, not loss. So there's a big difference between make a profit or loss, while many European, Southern European banks are kind of making losses all these years. Leverage ratio, that is something that we started from. We're around 24 times, and now they have gone down to the level of, say, 14 times. So massive development also kind of for stronger balance sheets there. A snapshot, more recent, this Deutsche Bank's analysis ended in 2018, taking a more recent snapshot of European banking country to country. We see that this is a, let's take a look at this, say, equity tier ratio 1. So in Estonia, kind of almost 30%. The strongest banks in Europe are in Estonia. In Greece, Spain, Portugal. So these still are kind of a bit lower than the European average. But if you look at the levels, so we are talking about something like 15, 16%. So average, the levels are kind of where they started was, there were many banks having these less than 5%. So clear strengthening of the balance sheet. It's kind of all the countries, but still obviously there are some changes, also differences from one country to another. Finland there is somewhere in the middle. Non-performing loans ratio by country. Here Greece looks kind of doesn't look so good. Kind of non-performing loans ratio is something like 14%, but it's much better than what it was in the past. Cyprus is there, Portugal there, Italian banking sector was facing major kind of challenges just a few years ago, especially in terms of non-performing loans, but they have been able to now manage to somehow solve these issues. So they are not that massively kind of say 2%, the average non-performing loans, which is Finland is close to 1%. So 2% would be somehow manageable. So Italia has something around 4%. So currently it looks that the Italian banking sector has on average become healthier. There still are a few kind of banks facing challenges such as this Monte dei Paschi still. A lot of money has been poured, and Monte dei Paschi was nationalized, so major kind of changes have been made into operations in Italy. And then the last one, on the first section, the profitability. This is the big thing, kind of the banks which are profitable, they can take hits, and they can take hits in the profitability. But this is in the big picture, you can see that there's a net interest income In the US here, from 2000 to 2018, Europe and Japan. And if you look at these levels, so on average, the America, the net interest income is around say 3%. So that is the margin that make banks borrow money kind of at 1%, they lend money at 4%. So the difference, interest rate difference is 3%. So that's pretty healthy and has been healthy in Europe, in the US all these years. When in Europe, first of all, it has been on the lower level throughout these years, and now it was in 2018, it was only 1.65. So almost half of the US. Not to mention the Japan, which is 0.9. So this is the source of the challenges of the banks, that the profitability from, say, and now let's make this clear, from the traditional banking business. Banks borrow money and banks lend money, and the interest rate differential called net interest income is the larger it is, the better for the bank's profitability. Banks' profitability have been lower in Europe than in the US. So that's one major reason why US banking sector has recovered kind of faster from this crisis. Any questions, comments? Anything like to ask? Any clarification? Is there any specific reason why Baltic banks are strong? Very good question. Kind of to be honest, I do not know. Tomorrow on Friday, I will have, if I have the opportunity, I will have a speech at the Estonian Economic Association annual kind of seminar. If I have the opportunity, I will ask. Kind of there are the Estonians are there, economists. If you look at kind of Estonia as a government, so extremely strong. Kind of they have a tradition that they don't like debts. If you look at the debt level, which Finland is currently relative to GDP, what is close to 70%. Estonia kind of it's as far as I remember, it's around 10. So it's totally out of charge relative to other debted European countries, not to mention Italy 170%, Greece kind of 200%. Estonians have had a healthy kind of a approach to taking debt, and that might have a influence. That is just a speculation. Might have a influence also on the Baltic banking sector. So healthy banking sector. Are the current stress tests efficient, or do you know if there is some non-fraudulent off-balance sheet? Off-balance sheet items, and that is a very good question. As we have been discussing about derivatives. Derivatives typically kind of are off-balance sheet kind of items, transactions, and the risks do not they are not that visible in the balance sheets. I do not know if the overall kind of, as we can see, the derivatives trading activities have the activities much lower now than it was in before 2007 in US and in Europe. How is the current kind of, is there something kind of cooking? So I do not know. What I know is that obviously regulators have put emphasis on this area as well, as it was recognized that how big of a potential headache this can be. Then the question is that Olli is asking that it seems that the focus has been mostly to prevent banks going bankrupt. Has there been any serious proposal to change the system so that without recurring? Actually, this is a this has been kind of the development, kind of in concrete, kind of, you could say that the bank equity ratio, kind of the threshold, the minimum equity ratio from 5 to 8 to, and so on, now it's currently around 15%. So that in other terms, in other words, it means that shareholders do have more risk capital tied to the operations of the bank. So essentially what this is the goal, this is what has happened, is that now the more risk, say that the bank has 15% of equity in its balance sheet, so bank can take hits in the profitability by just making losses, and these losses are they being absorbed by the shareholder equity. So bailouts are not required. So that is the overall kind of a idea in these strengthenings of these or tightenings of these requirements, that taxpayer money is not needed. So that is actually what has happened, is that bailouts would be not needed at all, and if they happen, as we'll talk about kind of in a minute about this European Banking Union, one of the pillars is also kind of trying to tackle the situation when a bank really is being kind of facing serious problems. So what happens then? So that is called the resolution mechanism. So there has been a lot of good development in the regulatory kind of environment in Europe from taxpayers' perspective. Then the question, how big of an effect are the European countries' debt GDP ratios having on European banks? Very good question, very tough question. But trying to answer that kind of the overall recognized, say, challenge in European banking sector was something that was recognized especially in 2011-12 European kind of sovereign crisis, was that there's a clear link between the sovereign crisis, so a country facing debt crisis, and the local banking crisis. So that's how Europe overall, the architecture, kind of the whole environment is very different from, say, in the US, which is there are 50 states. And if you just think of it, say, as an example, bank operating in California, so they do invest in bonds, most probably, but they do not invest, say, majority of their bondholders is not in the bonds of California, the state of California, but it could be the treasury bonds of the whole US on the federal level. While in the Europe, the tradition is that the Spanish bank when it invests in bonds, it invests in Spanish government bonds. So there is a clear kind of a risk exposure to the local government bonds, which is not good. So as we recognize, say that was mostly visible in Greece, Greek banks facing difficulties in their operations, plus when the Greek government was facing difficulties, so Greek banks had invested in Greek government bonds, facing difficulties in their basic operations, plus the investments were kind of at a loss. So that was a double-edged sword, kind of they made losses on both sides. So this was figured out that this is not good for the healthiness of the European banking sector. And all these years since 2011-12, so actions have been made to make this kind of disappear. It has not disappeared yet, but the challenge has become of a less severe, kind of in terms of magnitude. So still, kind of say Finnish banks invest first in the Finnish government bonds, Spanish banks mostly, but less so in Spanish government bonds. So if that is a answer, so it is a big thing, because bond investments have been historically pretty big proportion of the bank, not a major, but pretty big kind of a source of the investment portfolio. So that's where the link comes from, the link of banks' profitability and the government debt to GDP. And I was seeing the next question. I was wondering, what is your opinion? I'm very kind of cautious. You must be cautious when you ask me opinions. Kind of opinions are just opinions. Banks have lent money big time. It has been cheap. Now the inflation is rising. Nobody knows for sure. Obviously, kind of that is a headache of a history that central banks are currently having, as and that is something we'll discuss separately when central bank policy will be discussed, and the role and tools that central banks do have. Central banks have been, since Mario Draghi said this, the famous "whatever it takes," European Central Bank is willing and capable of doing. So ever since the central banks have become more and more, or bigger and bigger and more important players in the markets, lowering, pushing the interest rates to a low level, both short term and long term. That has led to kind of a massive kind of increase in the leverage, both in US and in Japan, but also in Europe. And how to take steps back, and that is what central banks are really facing difficulties, and especially now. That's why this is the most interesting time in the markets currently, as so far inflation has been below this 2%, which is kind of the target has been officially. Now, if inflation really picks up, nobody knows, to make this clear, nobody knows what will happen, but there are clear signs that the inflation is not that transitory as it is the current formal the policy or the formal statement by European Central Bank currently. If it turns out that it is not transitory, it doesn't go away, but it actually keeps on the high level. So what will the European Central Bank do? That is what they are following, what Fed is doing in the US, and they have hard time kind of in raising interest rates, you'd say, at all. Say, if just imagine that interest rates in Europe would be on the level of 2%. Now, as the debt levels by Greece, Italy, and other European countries, and also investors, so they are facing kind of the most difficult time that they have faced for many years. So that's why this environment is so exciting. And I can't solve that myself. I might have some opinions, but kind of I try to kind of follow with great interest what the central bank is kind of how the policy is being changed. Any expectations towards the result of next stress tests? I haven't heard any, and I guess overall the situation is, as we were able to see, somewhat kind of a healthy overall. So there are many risks in the market, but banking on average is much, at least what we know is that much stronger than it was especially 10 years ago, but also stronger than it was kind of a couple of years ago. So I would not expect that the next crisis comes from the banks, but it comes from somewhere else than the banks as such. Individual banks do face difficulties. Could be that there are collapses of individual banks, but overall the banking sector is much more healthy than it was several years ago. Any expect at least Finland is changes for the towards the parameters are being changed and regulation kind of develops all the time, and say we will discuss this next Tuesday when this kind of equity ratios are being kind of discussed. So that parameters and the minimum requirements and how are there some floors? So that is a gradual improvement, gradual development in the regulation we see all the time. You could say, of course, and that is good, but not the mass. I don't see currently that there would be a need for a massive European level-wide kind of a stress tests for European banks. Then the last question: would European banks perform with or without the European common currency? To be honest, you could say as in the European kind of law series, objection, speculation. So that is kind of that is speculation. It is too difficult of a question that I could answer. Obviously, this European, say euro as a European currency has led to much smoother ride. The development has been much smoother overall over the past 20 years than it was. I remember how it was when Finland has its own currency in the 90s, 80s, 90s. So when the currency is developing every now and then, there are massive kind of losses. So massive kind of discontinuities in the market. So overall, the environment has been more smooth, more stable, and you could say the more stable the environment is, the better for the banks. So I guess that is my overall. I'm not anti-euro or for euro, but it's just kind of an overall takeaway from euro is that it has made the environment, and so that means planning for companies, for individuals, so much easier than how it was before the euro was adopted in when was that? It was in 1999, or was it just 2000? And was it just 20 years ago or so? So massive jumps, European crisis, kind of sovereign crisis we have went through, but kind of a overall crisis come, crisis go. Overall, the ride has been relatively smooth, you could say, from banks' perspective. And if you look at especially the Nordic banks, the profitability has been kind of pretty good through all these years, except Icelandic banks, which was a one very interesting kind of case. Wasn't that kind of an inside job movie where the movie started from? Okay, shall we go to European Banking Union? It's kind of, I thought we would have a coffee break, but let's not have a coffee break, but continue kind of until the end today. Now it's 2:20, 2012. So who is this lady here? We know her, don't we? We know her from the movie. Head of ECB, right? Christine Lagarde. Christine Lagarde, in the Inside Job movie, she was interviewed as she was the finance minister of France. Since that, she was appointed as the head of IMF, and currently she is the head of the chairman of ECB after Mario Draghi. So, a really powerful, influential, capable kind of a person. So, what Christine Lagarde said as the IMF head in 2012, while there was this European kind of the sovereign crisis was really kind of current. So the euro area situation called for policy game changer with urgent steps to banking union. So European Banking Union. There were some other suggestions as well, such as fiscal integration, blah, blah, blah. But banking union was seen as there was a major need for European Banking Union. And what this European Banking Union is about, the first one, that is something that we already discussed, single supervisory mechanism. So supervisory kind of activities cannot be led to be on a national level only. No, we need on a European level, and that's where the ECB took a big kind of responsibility by starting supervising the biggest banks. single resolution mechanism, the second SRM, and the third one is European Deposit Insurance Scheme. So 3 pillars. And as European Central Bank said, the need for banking union emerged from the financial crisis 2008 and the subsequent sovereign debt crisis, as we have been discussing. And this is exactly what I was kind of referring to. It became clear, especially in monetary union such as euro area, problems caused by close links between public sector finances and the banking sector can easily spill over national borders and cause financial distress in other European countries. So that is a sovereign crisis in one country can lead to a banking crisis, which would then lead to a kind of as a domino effect to banking crisis in another country. Single supervisory mechanism, as we were discussing already, comprises of the ECB and national supervisory authorities of participating countries. So that is a big change from how it was. The previous Spanish banks were controlled or supervised by the Spanish banking authority only, supervisory authority only, and the same in Finland, the same in Germany, and so on. So no longer, especially for the big banks. Single resolution mechanism. The idea here is that there would be an efficient resolution of failing banks. So when it happens that, okay, now the threshold has been set higher, banks need a bigger proportion or much more equity to be allowed to run the operations, more equity, shareholders' money involved. When banks faces, say, credit losses or other risks do realize, the first step is that, okay, bank makes a loss, which is kind of implies that there will be a decrease in the equity shareholders or shareholders' equity. But that would be kind of, shareholders would take the hit. As like in any company makes a loss, okay, shareholders do take the hit. Then it's up to the shareholders to decide, okay, whether we want to kind of have a rights issue and invest more money into the company. Do we believe in this business or what shall we do? That is the overall kind of a setting. If this is not enough for a bank, and a bank makes massive losses so that equity shareholders is being kind of eaten, so it's not enough to cover the losses, and shareholders are not willing to put their more money, kind of good money after the bad money, as the saying goes. So then the bank is at the risk of failing, and then this bank will be kind of be taken over by this single resolution board. So this did not exist before this before 2012. They started operations I don't know how many years ago, something like 10 years ago. What makes this interesting from our perspective is that Timo Löyttöniemi was the first vice chairman. Timo Löyttöniemi is the CEO currently of the State Pension Fund, alumni of our school. So he was, for the first 5 years, he was the vice chairman of this single resolution board, building the whole institution. So now there is an institution called single resolution board. If it happens, something that nobody would like to see, but if it still happens that one bank kind of is close to going to bankrupt, it will be kind of handled by the single resolution board. And the idea is that they will take the actions necessary, whatever those actions are, so that they will not put their own money in the bank, but they will somehow structure the bank so that it will be kind of it can be sold to some of the market players. The structure could be changed so that typically the management must leave, and some other kind of whatever needed whatever cost structure kind of changes are being needed. They will do this in a very short time period to avoid taxpayer money being needed to put into this bank. So that is the idea, that there's a clear path for banks who are close to failing, which didn't exist before the crisis. The single supervisory mechanism is, as we're discussing, the biggest banks, significant institutions, they are the assets, banks which have greater than 30 billion, or the 20% of GDP of the member state, they are directly supervised by ECB, such as Nordea is one of these. Less significant are monitored by national supervisory authorities. The resolution fund is, you could say in short, they are winding down the non-viable banks, the banks who have no other kind of way of thinking than how to move forward. So they are taken over by this single resolution fund. Those are the two first pillars. The third pillar is something called Common Depository Guarantee or European Deposit Insurance Scheme. EDIS, 2015, the Commission proposed to set up this European-wide deposit insurance scheme. As there is currently in all European Union countries, there is this deposit guarantee scheme, which kind of guarantees that all deposits up to 100,000 euros per bank, per customer are being covered, so that any depositor who is having, say, extra cash up to 100,000 euros does not need to worry about the riskiness of the bank, because there's this depository guarantee system taking care of that. But the idea is that kind of the pillar 3 would imply that we would have a kind of European-wide instead of national as we currently have. And this is something that is still pending, and this is a political issue, as Politico article from last June pretty nicely kind of summarizes. Germany is especially kind of against this. Southern European kind of countries, France and other, they are for this, but Germany says 9, as this article says. The German, actually Finnish politicians are also saying 9. Finnish banks would be kind of Nordea, for example, have said that okay, this would be good for the development of the whole European sector. Not has taken place yet because say Germans and say Finnish politicians are worried that if we kind of mutualize the whole system, so there would be a risk that say Northern European taxpayers would need to pay, or Northern European banks would need to pay some risks that have been that we realize in Southern Europe. So this is pending. So of the European Banking Union, 2 pillars are up and running, and a third one is pending. And then one more step in trying to make European banking sector more resilient and viable, and say overall kind of, and not only banking but other European economies as well. Business is flourishing, so European Capital Markets Union. And this is something that European Commission kind of in 2015 started building, and the idea is that it has been long in the making. European economy overall is as big as American one, but equity markets are less than half the size. The debt market is less than a third. So the capital market in Europe is not as developed as in the US. That is the starting point. So European market is very much kind of bank driven, bank oriented have been, and now what we learned when everything kind of went smoothly, nicely, kind of everybody was happy, kind of being able to borrow from the banks. There was no need to develop, say, bond market for corporates or say other institutions. But now we face that the more reliant we are on banks, when banks face difficulties, so that will have direct consequences on real economies as well, say companies. That was not that at all, you could say, recognized in Finland. Even the Euro crisis, banks were able to lend money as much customers kind of were willing to take, borrow. But in Southern European countries, that was clearly kind of a challenge. The biggest bottleneck of big companies, kind of, and especially medium-sized companies, they didn't get financing from the bank because banks were having difficulties themselves. At the home, their home base was burning, so they were not able to lend money for customers. So that prevented these companies' kind of growth. So some changes is being needed. As it's pretty good kind of saying goes pretty well, kind of as the economy of Euro area is like airplane flying on one engine, bank lending. So bank lending was the dominant, but we would need another engine to kind of in the capital markets would diversify, especially for small and medium-sized companies. So that is some change was needed. And just as an example, how significant the banking sector has been, how dominant it has been. This is from 2017. US, relative to GDP, the banking sector is with less than 100%, while in France, Ireland is kind of 350%. So banks are dominant in Europe relative to the more dynamic US. America has its own problems, obviously, many problems, but in financial sector, they have been flying with two engines for all these years. Very good report by Goldman Sachs 2015 indicating kind of how bank-centered financial model in Europe, where if you look at kind of bigger companies, they mostly finance the operations from the bank, something from directly from the market, say issuing bonds. When the US, its banks are of much less of an importance. And also the same kind of results in the banking sector relative to US over years has been kind of, it's 2 to 3 times, actually 4 times greater than in US relatively. Small and medium-sized enterprises are more important than Europe. We have more these small, medium-sized companies. They mostly kind of finance operations from banks. So now as banks have been kind of facing difficulties, that leads to small and medium-sized enterprises kind of facing difficulties as well. This is banking. Another area, this is just a comparison, very nicely kind of illustrated comparison of the US and Europe, say leverage loans markets, venture capital market in the US, European, this blue kind of shows that how massively kind of smaller European market is relative to US market in terms of risk capital, high yield bonds, private equity, IPOs, venture capital. So America is able to offer, the American system is able to offer much more risk capital for companies to grow. Well, obviously, bank loan is not good for a risky investment. So banks are not, because banks are not getting any upside potential, so banks are not willing to lend money for the risky projects. While venture capital money is by nature is risky capital. Private equity capital is risky by nature. So to allow more risky investments in Europe, it has been recognized by European Commission that we need to develop these risky capital markets on top of the banking sector, bank loans. As Hill was the commissioner of this sector in Europe, he pretty well kind of said that in European capital markets, companies need more choices over funding to grow. Reducing resilience on bank funding and to make the whole financial system more resilient in Eurozone. I find it very difficult to disagree with this. Does not mean that it's easy and it can be solved overnight. It is a cultural issue. One major kind of setback in this development was when Brexit took place. So Hill, kind of from England, he was very much kind of pro European Capital Markets Union. So Capital Markets Union in England, which is a market-driven kind of, and England overall is kind of the market structure. If you look at the size of banks, size of the risky capital, it follows very much kind of America, while continental Europe, German, France, they're much more kind of, you could say, old-fashioned. Now, as a result of Brexit, we lost these strong advocates for the functioning capital markets overall. So that was a big setback. Kind of, I don't know, I have no opinion about Brexit, good or bad, it's their decision. But in terms of capital markets development in Europe, that was definitely bad kind of a news. What is European Capital Markets Union is about? Kind of in one picture, kind of if you think of kind of companies growing, so when they start, when the company starts kind of operations, it's kind of as there's a saying, kind of friends and fools and family members are being financing the company. Then you get some retained earnings. At some point, kind of you grow, you get some bank loan. Yeah, this is kind of the banking sector. Kind of the early years, companies are growing typically through kind of the founder putting his own money or her own money and borrowing some money from the bank. But then, with the size grows, size of the company grows, and the company needs to take more risks. So there will be peer-to-peer kind of financing. So there will be business angel kind of financing, crowdfunding, venture capital money, private equity money, private placement, IPO, debt market, kind of public listing. All these IPOs are public listing. So Capital Market Union is about this kind of a sector. When the company grows greater, the more kind of different alternative sources of financing the company needs, the more risky capital it needs to diversify the risks of financing. So that's where the European market has been lagging, especially the US over the recent years. About the Capital Markets Union current status, very nice kind of update currently is from one of the articles I added as one of the reading list by Domercis, Dominics, Jimenez, Huetta, Jana Raud, whatever how you pronounce it. Europe should not neglect its Capital Markets Union. This is an update from last year's June and one of the articles in the reading list. So please take a look at this article. You get a pretty good picture about the history, why Capital Markets Union is important and what is needed kind of currently. Any questions, comments on what we were discussing today? Stress tests, banking union, Capital Markets Union. Are we able to answer the question that I proposed in the start? Bank stress tests, why so many? In Europe, the first ones executed 2011-12, we recognized that actually it was not good enough. We needed something more. 2014 needed the asset quality review. European Central Bank took the helm in terms of supervising the biggest banks. They needed to figure out really kind of what are the banks kind of about, as they will be kind of responsible for their supervision. Environment has been kind of weakening, kind of despite, of course, we had liked that kind of environment would be getting better, but especially in Southern European bank, kind of the non-performing loans have been kind of a major headache. We have needed kind of several stress tests, but currently my feeling is that there is no need. There are no plans to make another round major like these. Why European banks have underperformed? Profitability overall, the interest environment, non-performing loans. So, but overall, the profitability kind of is a big challenge for European banks, and that is something that we will discuss on next week, not next Tuesday, but next week's Thursday especially. So, environment has been challenging. There has been challenges such as kind of the link between the sovereign risk and the banks investing in the local government bonds instead of the European bonds, which haven't existed yet. So how European banking is going to be fixed, stress tests, European Banking Union, and then European Capital Markets Union. Question is, why is it harder for private equity and venture capital to operate in Europe compared to the US? Why is the market underdeveloped? Very good, but very difficult question to answer, because it's not, say, mathematically you can't kind of calculate it. It's kind of and this is where this whole things become interesting, you could say. As I mentioned, in England, there is something called equity investing culture. We talk about culture, and culture is something that is very difficult to define. It's an end result of what has happened in the past, and there is a risk appetite. Investors have so investors are willing to invest their pension savings in equity markets. They are long-term investors, like in the US. And as you get used to long-term investments, you start investing in equities. You recognize in the long term, okay, you face risks, but in the long run, kind of your returns are better. Also, you are willing to take additional risks as well. You are willing to invest in non-listed company or not listed company startups, whatever, private equity funds, and the regulator also allows, say, pension investments being invested. The whole infra is set so that individuals can invest in funds which are being managed by professional private equity or venture capital fund managers. And so the whole ecosystem builds from the regulation and investor kind of the culture. While in Germany, which is kind of, I don't know whether it's the other extreme, but it's kind of bank-centric. German investors typically invest in bank accounts. Finland is pretty much like kind of somewhere between England and Germany. You could say that closer to Germany. As I said, that Finnish households have this 100 billion over that on a bank accounts, yielding nothing. So our historical kind of our heritage is that we are very risk averse. And that can be, end result can be seen from our savings. Finnish households, the biggest investment we have is clearly in our kind of housing. The second biggest is our kind of leisure homes, and then comes kind of a bank accounts. So investments typically kind of say mutual funds, equity funds, direct shareholders, kind of they are much less than 100 billion. So historically, we have been not willing to take risks. That's our parents, and that's kind of even my generation. But you are, as you are my children's generation, you are different types. You are willing to, you have learned to take risks and invest in equity markets, mutual funds, direct kind of, and then also non-listed companies. So I hope and I believe that kind of things will change, but they don't change kind of overnight. That is the challenge here. That kind of it takes long time. So it takes that you will be in power, you guys. So it takes 10, 20 years that you will have the big money and you will make these kind of developments. So it doesn't happen overnight. History, yeah. History, Thomas Piketty's book, extremely good kind of capital in kind of 21st century. As the capital in longer run tends to turn rent-seeking, that is kind of extremely, it's pretty lengthy book. It's kind of informative kind of a, you could say, lot of information there. But if you can read that kind of through, it is clearly kind of shows how very recently in Europe, the money, just one can't kind of overemphasize how recent this change has been. In say 50 years ago, 40 years ago, who were the wealthy people in Europe? Those were the ones who were owning a lot of land, forests, kind of agricultural kind of whatever assets. Those were the people who were the wealthy ones. How things have changed in less than 50 years. Currently, the big money they are the founders of companies, startup companies, bosses of big companies, kind of through the option schemes of other share incentive schemes. So this change has taken place in clearly less than 50 years, and that is Europe. One in Europe, in America, it has been kind of like this kind of for tens of years already. So still, if you look at kind of the big money, kind of the big ticket guys, the billionaires. So in the US, they are the ones who are kind of self-made men, kind of entrepreneurs. While in Europe, they still typically are the ones who have inherited the money. But it's changing kind of gradually. These historical cultural differences, they are the most interesting, but at the same time, most difficult to kind of and challenging issues to explain and to measure, obviously, because you can't measure. But overall, you could say that Europe has been risk averse, while America has been kind of not risk lover, but kind of willing to take risks. While Europe is now there have been big kind of changes in the regulation to like in Finland we have this kind of osakesäästötili. That's one small step kind of to encourage Finns to start investing in shares. It was taken place, what was that, 2 years ago. So very recent development. But luckily you young guys, kind of you are taking kind of you are using this opportunity, investing in shares and so on to get used to the risk taking. So European companies might better investment than American because they pay bigger premium for the same. Might be. Yeah, currently you would say that, okay, from today on, if you think that the valuations are lower in Europe, you should do that. If you really believe that there will be kind of this transition in Europe, but obviously it's kind of, it might take a long time before this transition kind of really takes place. Okay, thank you very much for today. I will ask if I have the opportunity in today's kind of Estonian Economic Association's annual meeting about how they are how the banks are showing good health. I'm not an expert kind of on that. I will explain that you on Tuesday. Tuesday we will discuss about kind of commercial banking kind of basics, and we'll take a look at Aktia. If you have time to kind of please take a look at the material beforehand if you have any questions, but see you next time, kind of next Tuesday at 1:15. Cheers.